Morning, everyone. Thanks for joining. We'll just give it a minute to allow a few more people to dial in, and then we'll kick off. All right, let's start. Good morning, everyone, and thank you for dialing in today to the MaxCap Group webinar. My name is Ben Klein. I'm the head of private capital, and it's great to have you with us today. Joining me from Sydney is Bruce Wan, our head of research, and alongside me in Melbourne is Baden Adams. Baden is the portfolio manager for all of our debt fund products, and notably has been instrumental in the structuring and the day-to-day management of our flagship debt fund, the MaxCap Investment Trust, which he'll touch upon later. And my sidekick, Liam Howley, also assisting today from Melbourne. I will remind you at this point that today's call is being recorded. All participants dialing in have the ability to submit questions via the Q&A function that you'll find at the bottom of your screen. We will attempt to address all of these at the back end of the call. Should we not get to all of them, rest assured we will reach out directly and have them addressed. So quickly, by way of agenda for today's call, I'll give an oversight on all things MaxCap and where we are today. Bruce will then deliver his latest research and market outlook. Bruce is a wizard of stats and facts and always manages to convey his words with flair. So I do encourage you to listen in with intent. We'll then switch over to Baden, who will give you an overview of the MaxCap Investment Trust, which is our flagship open-ended fund that's just ticked over a year in market. We are incredibly proud of the MIT product that we've developed and its performance to date. And we've now also added some recent enhancements, which I'm sure will appeal to all investors. The MIT already boasts circa $300 million in commitments, both from institutional and private investors alike. And we do have very ambitious goals to scale up this fund significantly over the next 2 to 3 years. And then following Baden, we'll come back to Q&A at the back end. So kicking off on how things are tracking over at MaxCap, look, we do note that it is a challenging environment out there. MaxCap is being as discerning as ever with the deals that we are looking to mandate. In terms of some stats on how we're sitting today, we've ticked over $18 billion of loans invested and advised since our inception, which we've now reached into our 17th year of operation. Currently, our funds under management and advice sits at around $7.2 billion. We've originated 675 plus, I think it's closer to 700 loans to date. We maintain our ranking as the #1 real estate debt provider by PERE in Australia and #2 across Asia Pacific. We were also recently anointed with the Senior Lender of the Year at the recent PDI Awards. Our current pipeline is robust, sitting at around $5 billion of potential deal flow, a healthy number that gives us the flexibility and the opportunity to really pick the deals that we want to progress and let go of the ones that don't stack up, a very important point in the current environment. Proudly, we recently moved into our new offices on Collins Street from the start of this year. It was a work in progress of over 12 months, and I encourage you all to come in and see the space, which is truly incredible, positioned on the corner of Collins and Queen Street. We now have over 100 staff across our 5 offices, be it Melbourne, Sydney, Brisbane, Perth, and Auckland. Our partnership with Apollo Global Management continues to flourish. This is now pushing 2.5 years since they joined as a 50% owner of MaxCap in 2021. This relationship is flourishing. They continue to open doors, create a broader network for MaxCap globally, and strengthen a lot of our day-to-day operations and governance. And it's a partnership that we're truly excited about moving forward over the coming years. In terms of our institutional capital partners, some of these have been with us for a very long time, and the relationships remain strong and sound. You can see some of the names on the screen in front of you. CBUS, APG, who are a Dutch pension fund, who are looking to re-up their current commitment to us. AusSuper, ABL, who are a Korean insurance firm. Athora is the insurance arm owned by Apollo Global Management and with operations out of Europe. We took on a new commitment from a Nordic pension fund in Q3 of last year, and that has gone really well, and they are looking to increase that commitment in the short term. Beazley are an insurance arm out of England. CEFC, Australian Sovereign Clean Energy Fund. There are also another one coming on shortly, which we're excited about, out of the Middle East, and a number of other discussions which are very well progressed. Just briefly touching on the private capital side of the MaxCap business. Private capital is a critical part of what we do. The business was born out of private capital, and it'll always be a strong part of the day-to-day. This number fluctuates somewhat, but at the moment it represents about 2.6, 2.7, 2.8 of the funds under management. And will always be a healthy portion of what we're doing. Very excited to say that as of next week, we will be launching our investor portal. This has been a work in progress for some time. It is an exciting feature which will be added to our website, where investors will be able to log on at any time, see a snapshot of their portfolio, have access to reports such as tax statements, unit certificates, and the like. And this will become more interactive over time as we continue to build out the functionality of the portal. In regard to the ways in which private investors can participate with us, one, as I mentioned, is the MaxCap Investment Trust, which Baden will touch on further. And the other is the deal-by-deal opportunities, which we've always had and continue to bring to market. And I can confidently say that we do have more deals on offer than any other competitor in the space. Last financial year, for example, we closed 45 individual privately syndicated loans, which was over $1 billion. This was heavily skewed towards first mortgage, but it did cover the capital stack across first mortgage through mezzanine and right up to direct investment syndicated opportunities. We continue to see really strong demand for private credit, with global interest coming from some of the world's largest investors. We're seeing good inflows from private capital as well, largely through Asia, who continue to support the Australian story. We also have been expanding the private capital team. We've got representatives in each state. We've got myself and Liam in Melbourne, and we've recently added Penny Tao, who brings over 20 years of experience from her former banking days and has already given us a great reach into the domestic Asian market. In Sydney, we have Layla Sachs and Hugh Thompson, who continue to grow the New South Wales business, Michael Ianson in Queensland, and Nick Adamson, who both provide really strong support for the investment directors who are on the ground originating loans, providing capital in the local state regions. In terms of the loan book at present, it's worth touching on, it sits at about 130 loans today. It is in healthy shape. There are loans on watch. We continue to manage our way through those. And given the environment, we are working harder and being more prudent on which deals we mandate, on the borrowers we lend to, and the builders that are providing builds on the jobs. We understand that things are taking longer, that there might be extensions, such is the nature of the world around us today. But rest assured, the ongoing asset management of MaxCap is something that we are delving into daily and is in very close watch. But I suppose just to wrap it up, we continue to grow. It's an exciting space. We feel like the market is getting larger with the retraction of the banks, and we will continue to see great opportunities for our investors. So with that, I might just pause and hand over to Bruce, who's going to dig in with his market outlook.
Thank you, Ben, and hello, everyone. My name is Bruce Wan, Head of Research for MaxCap. My job today is fairly simple. I'm here to give you, over the course of 20 minutes, a market outlook, some sense of where the investment markets are, how challenging it is, and most importantly, give you a sense of how to make money in this sort of market environment as well. But then, to start off with, it's important to get an understanding of this macro environment in front. And you can start see from the charts in front of you, we can see things like growth, inflation on the left-hand side on a scatter plot. And the key message to draw out from these squiggles is that over the course of the last decade or so, we've had a very good run in the economy, very sort of a moderate growth, very low inflation. And that's been a world that's been very good for real estate, for equities. With the disruption from COVID and what happened since then, we've had a recession, we've had very strong inflation. And what we're seeing now with increases in interest rate is a very weak sort of growth environment. What was very easy for real estate and equities is now very challenging, and investors are looking more broadly into other things like private credit to find more consistent income. So this environment is expected to be quite sluggish, and we're seeing this sort of right around the world. So in the UK and Germany, those economies are in recession. Japan, what was a recession, has been revised away, but also very weak growth. But right around the world, we are seeing this very consistent theme playing out of weak growth, high inflation, again, pushing investors away from traditional asset classes. Australia has sort of avoided most of the worst downsides of that. And the reason for that is you can see on the right-hand side. Australia would have fell into recession with those other economies if we didn't have this migration population boom that you're seeing on the right-hand side. And it's not just the sort of influx of migrants that we've seen over the last year or two with the reopening of borders. It is something that's longer, more durable over the last 10 years plus 10, 15 years as well. All those things have very positive implications for things like a housing sector and also adjacent sort of living sectors like student living as well. And I'll touch on those positive opportunities a little bit later. But over the page there, we do see some near-term challenges for now sort of still affecting the economy, not just weak growth, but also high inflation. On the left-hand side there, you can see the annual inflation for consumer prices in blue and also housing construction costs in gold there. There was last year quite a sizable acceleration in inflation to about 8% for consumer prices to 17% for housing construction costs. What is nice since then is that we've seen some peak and moderation in that inflation rate. Construction prices have slowed more dramatically to be back into the sort of a Reserve Bank official target. But the more important one is consumer prices. They're still sitting above the official 2 to 3% target band. It is still affecting Reserve Bank. We'll have a meeting today, but it is still affecting their sort of interest rate setting. And I'll touch on that a little bit later. But for us in the real estate industry, in the construction industry, what happens to construction costs matters greatly in terms of the financial health of the builders. On the right-hand side, you can see the cost components for a lot of building materials. And you can start to see things like fuel at the very top there, but also working your way down the list, things like steel, timber. They've found a peak in inflation. They are sort of starting to fall outright in some of these prices. Now, not everything's falling as yet, but things like construction wages, cement, they are still rising a little bit, and it's still sort of holding up that inflation rate. But the worst of that inflation shock that we saw in 2022 and 2023 is behind us. It is allowing sort of builders to rebuild some of their profit margins, and some of the strain that we saw in this industry, in the sector last year, is starting to fade away a little bit more. But over the page there, we can talk a little bit more about that construction, maybe on the interest rate before we move on to the construction. With that high interest rate environment, it is still affecting central bank policy setting for interest rates. And you can see on the left-hand side for Australia, for a number of other major economies, what was a zero interest rate setting 1 to 2 years ago is now dramatically higher. Again, investment strategies like equities and real estate that work very well at zero interest rates don't work as well. And you are seeing a lot of people moving from private equity into private credit as a result. Basically, whereas the sort of interest rate rises, borrowers have to pay more, lenders receives more, and you do get a transfer of wealth from borrowers into lenders. In terms of looking forward, the outlook for interest rates, a lot of economists have very different, diverging opinions. I'm more reliant on financial markets, particularly the forward curve, as the best estimate for forward interest rate movements going forward. What we're seeing in Australia is very different from what we're seeing, expecting for Europe and for North America, where they are expecting dramatic rate cuts from the middle of this year into next year. Australia, given a lower interest rate setting, less concerns about the economy, all of those reasons are suggesting a milder interest rate profile as well. So we are not expecting in Australia sharp, dramatic interest rate cuts. So, we don't see real estate, equity, or shares roaring back to the same extent. What is priced in today is 2 rate cuts over the next 2 years, one towards the end of this year and one sometime next year as well. So that high interest rate environment that's so beneficial for private credit for lenders is expected to persist for the foreseeable future. And over the page there, we can see, coming back to the construction outlook, our starting point was, we've seen very strong migration, very strong population growth. As a result, we saw very strong housing demand. On the left-hand side there, you can see the corresponding housing supply outlook, and you can see things like housing, building approvals, housing starts, housing completions, all slowing down because of that high building costs and high interest rates. Where we are today at around sort of 40,000 dwellings a quarter, we're well short of the sort of close to 50,000 dwellings we need every quarter to sort of meet that demand. As a result, we are still seeing a very positive residential market going forward for both prices and rents, and I'll touch on those things later. But the main risk you can people think through in terms of the building sector, you can see on the right-hand side, is that sort of lagging adjustment of things like costs, interest rates, and sort of lower profits for builders from last year, and how that's affected things like corporate insolvency. So builders sort of going bankrupt and falling over. And on the right-hand side, on the middle line there, you can see the construction sector, their insolvencies had reached a peak middle of last year and has been steadily slowing down ever since. And the reasons for that is it is a lagging adjustment to the cost shock that we saw in 2022 and 23, and more the interest rate adjustments that we saw in 2023 as well. All of those things are expected to subside in 2024. And as a result, we do expect that profile to continue to trend a little bit lower over the next 2 years. But all of this means very positive adjustment and dynamics for the residential market over the next couple of years. We've talked about very strong demand, very deficient supply, marrying to form a very persistent undersupply in the housing market, likely to be lasting 3 to 5 years. And in the near term, we're already seeing some of the positive benefits in terms of prices on the left-hand side there. And you can see whether it's for Sydney, Melbourne, Brisbane, Perth, housing unit markets, we've seen a very strong uplift. There has been some pullback with the higher mortgage rate adjustment that we've seen over the last 18 months or so. But again, in the absence of that going forward, we do expect the price growth to continue rising over the next year or two as well. And the best way to sum up that dwelling price outlook, you can see on the right-hand side, it's a very simple model of dwelling prices for the 5 capital cities. And in history, I've done these forecast models for Asia, for Africa, North America, and Europe. Australia is relatively simple. You only need a few factors, things like mortgage rates, household incomes, population growth, building activity, and you can readily explain 3/4 of that movement in history as well. So you are able to pick the speed of that growth, the turning points in the market, just by understanding where mortgage rates, where population are growing as well. And over the next 2 to 3 years, we do have a more upbeat outlook for dwelling prices. We are expecting sort of mid to high single-digit price growth on an annual basis. And the simple reason is, the drag that was affecting the market last year in terms of higher mortgage rates, that's going to be disappearing. It's going to be turning around to slightly lower mortgage rate, but consistently we are still seeing population growth, rising income growth, a turnaround in building activity. All those things are still very supportive of that dwelling price market over the next couple of years as well. So, residential by far, anything related to living, things like student accommodation, we are very bullish on over the next couple of years because of that demand supply dynamic and the expectation for sort of moderate to firmer price growth over the next couple of years. Turning the page to the commercial sector, we do have a more of a mixed story. So where we're talking about commercial sectors, we're talking about things like office buildings, shopping malls, logistics centers or industrial sheds, and you can see how rents have performed on the left-hand side there. Certainly the darling of the commercial sector has been the industrial market with this sort of push for e-commerce, deliveries to your home. All of those things have pushed vacancy in those sectors to very low levels, below 1%. And we've seen a rental boom that's been unfolding over the last 2 to 3 years. Going forward, that rental growth will slow down a little bit more, but it is still outperforming other sort of commercial sectors that we expect over the next couple of years. For other sectors, it is still quite challenging for big shopping fortress malls. Rents are either flat or declining slightly. In terms of office and the adjustment to people working from home, we do see more of a divergent story, both across geographies, places like Brisbane and Perth outperforming, Sydney and Melbourne lagging a little bit, but also across different quality and locational segments. So, city centre, CBD office, stabilizing a little bit more, but still sort of seeing the tail end of a rental adjustment. Meanwhile, sort of facilities, office facilities around the city fringe are offering some degree of amenity, a little bit more space for people, a little bit more rental affordability. They are sort of coming back a little bit more clearly. But on the right-hand side, we can sort of summarize the outlook in terms of asset pricing, on the chart on the right there, where we're still seeing sort of falling prices because of high interest rates. For a lot of commercial sectors, we are seeing higher cap rates as well. But we do expect more and more of these sectors to be seeing turning points this year, particularly in the office sector, in the retail sector, because that higher interest rate environment interest rates are expected to sort of find a peak and eventually start to fall a little bit. And that should be the catalyst for turning point in the commercial sector as well. So over the page there, I do want to make a very clear distinction between investing in real estate, so owning the real estate and being in real estate equity, but also lending to real estate, which is real estate credit. They do have very different risk profile. Where you're owning the real estate, you do feel every bump in the road in terms of the real estate markets. Every time prices rise or fall, you're seeing that in your valuation, in your returns as well. But where we are lending into the sort of real estate sector, you do have a very different risk profile. You do have a lot more shock absorbers in terms of your investment, and you do see far more lower risk and far more consistent returns. And the way I show this in the two charts on the screen here, what you're seeing is on the left-hand side is for the residential market. On the right-hand side is for the office market. What we're seeing here is just a distribution of price growth. If you're looking at this and your first comment is, oh, that's a very platy-curtic distribution, you'll get full marks today and we'll send your price forward. But what we're seeing here is the price distribution for, let's say, the residential market on the right here, on the left here. It is mostly rising by a little bit every couple of years. We don't see big price increase. We don't see big price falls. And as a lender into that market, that's very good news. That shows a high degree of resilience. And the boxes on the left-hand side there just shows you our loan to valuation ratio. So if we're lending 65% for project, we don't really care if the market falls by about 35%. We still get paid as investors because those repayments are still coming through. So it's only when we sort of stray into the boxes there that we're a little bit more concerned. But the good news is over the last 30, 40, 50 years, we just haven't seen that in a lot of the residential and a lot of the commercial markets in Australia. And where we are today, residential is sort of returning to growth. Office markets still sort of seeing very modest sort of pricing declines. None of those is at a risk or at a sort of pace adjustment that's sort of causing us grave concerns about our capital and whether that's at risk or not. And we compare that in Australia compared to a lot of Asian, European, and North American markets. Our market is sitting very pretty in terms of that very tight distribution and very low risk profile that we just simply don't see in Asia or Europe as well. And I guess over the page there, you can see my closing point about this sector. We are sort of still doing a lot of real estate equity. And like I said, anything related to living, student accommodation, we're still sort of very sort of bullish on. But also we're very bullish on private capital as well. You can see the asset class returns on the left-hand side there. You can see the black line being commercial real estate lending on a first mortgage basis, where you have that second mortgage or any of the sort of higher sort of risk profile, you have higher returns, but a similar, very flattish profile in terms of volatility. And the key point is making that comparison between real estate credit and some of those other asset classes. So things like shares, bonds, owning the real estate or owning the listed real estate, you've seen far more volatility, both in terms of the ups and downs through COVID, through the rise of interest rate environment, where a lot of these asset classes were losing money consistently over a couple of years, something we just don't see in the real estate credit market. And on the right-hand side, you can sort of sum that up very neatly in terms of how that sits on the risk and return profile. The return you can see on the vertical axis, the volatility or risk you can see on the horizontal axis. Where you want to be absolutely is on the high return, low risk environment in that top left corner. And you find things like real estate credit very consistent in that sort of spot there. And on the other sort of less desirable location, you do find shares, bonds, real estate, and risks having lower returns and high volatility. And those numbers may be academic to some people, but it is genuine returns that people are leaving on the table. Where that performance gap is, let's call it between 5% or 10% between sort of different asset classes compared to real estate credit. Let's say on a 10 million investment, where you're sort of seeing that performance gap, that 10 percentage point gap is $1 million every year. That 5% performance gap is $500,000 every year. That's a lot of money to be leaving on the table, by sticking into some of the lower performing asset classes. So my advice is be active, don't leave money on the table. With that, I will leave it there and maybe use that as a lead-in for Baden.
Great. Thanks, Bruce. And firstly, to everyone on the call, thanks for taking the time today. And it's a real privilege of mine to be able to talk through the MaxCap Investment Trust, MaxCap's new flagship fund. So MaxCap as a business has been operating funds since 2016. So they're coming up about 8 years now. Historically, this has been more focused on individual strategies, be that construction and non-construction. And we've more looked at closed-ended products, so funds that have a finite life period, say it's 4 years. In the middle of 2002, we conducted a piece of market research to both understand our competitor set, as well as understand where we sit within that competitor set. The two main goals of that project was, one, to simplify, consolidate, and optimize our fund product offering. And the second was to create a best-in-class fund product for our investors to participate in. And from this research and from all the work that we did, the MaxCap Investment Trust was born. So if we jump to the first slide, MaxCap has established an evergreen platform, being the MaxCap Investment Trust. And when we talk evergreen, that just means it's ongoing. It's not closed-ended, and we expect it to continue long into the future. And the main key benefit of the MaxCap Investment Trust is it offers our investors ongoing access to the Australian and New Zealand commercial real estate debt class. A key benefit here is the immediate exposure. So the fund itself has an established and large and scaled pool, which is diversified, of high quality commercial real estate debt positions. And the benefit of this is the regular income that this pool produces can be paid to our investors quarterly as a cash distribution. Within the MaxCap Investment Trust, we have two specific products, and these products reflect the risk profile of underlying investors and how they want to invest. The first of these is the first mortgage product, which by name is only exposure to positions where we have a first mortgage over the underlying security. And the second product, is our high yield product, which has a mix of both first mortgage as well as mezzanine exposure. Now, when I speak mezzanine exposure, I'm not talking highly spectacle preferred equity exposures. We're talking mezzanine exposures behind banks that have features very similar to what a first mortgage exposure would have, but just by nature of where it sits in the capital stack, it can be classified as a mezzanine exposure. Now, due to these allocations, there's different target net returns between both products. Both products have a target return over the RBA cash rate. So for the first mortgage, as you'd expect, which is a little bit further down the risk profile, has a target of 5%. And the high yield, which has the exposure to mezzanine debt, has a slightly higher 8% return target. Now, the fund itself, in terms of how it deploys capital, there's some very stringent guidelines and underwriting standards that we must meet to ensure both we are securing high quality opportunities for fund investors, as well as making sure that the pool itself continues to be diversified. And that's diversification across geographies, sponsors, and loan type. And that's to make sure that when we do deploy capital, we're doing it prudently, and we're making sure that deployment reflects ever-changing market conditions. Finally, on this slide, one of the key points that I do want to point out, and something I will go into more detail on, is the fund itself offers liquidity on an ongoing basis, effectively providing investors with the flexibility to redeem their investment in the fund as they require funds elsewhere within their portfolios. If I move over the slide to looking at them more specifically, so as I said there, first mortgage and high yield with their target returns, and while both being open-ended. When I talk about liquidity and redemptions, so we have the ability for investors to redeem monthly from the fund, and the fund is committed to redeeming 1% of NAV per month, the NAV being the net asset value. That is a commitment. We have to redeem that every single month. So where we have redemptions outstanding and those redemptions are less than the 1% of net asset value per month, we are obliged to make those redemptions. Now, that's not to say that is all we're going to redeem. We do have the discretion to redeem above that. That's more about matching cash flows within the fund to make sure that we can keep the working capital of the fund ongoing and operating. From a return of capital point of view, we return capital monthly as part of our redemption cycle. We provide quarterly distributions, so quarterly cash distributions. And in terms of our estimate of a maximum time for full redemption, now, this is a hard thing to estimate. What we do guide investors is that the maximum time is around 18 months. And this is based on the weighted average life of the portfolio. So if we take the portfolio as a whole, the weighted average life of every single loan within that portfolio is about 18 months. To put that in context, I'd say anywhere from 1 to 4 loans within the portfolio is repaying every month. So there is a lot of natural liquidity within that portfolio where cash events can be used to meet redemptions in excess of that 1% of NAV per month. The other point, 2 points to point out there is, one, we do have access to a cash facility, which we can use to both smooth cash drag, facilitate deployment, as well as to assist with redemption moving forward. And secondly, given this is an open-ended vehicle and will continue to take capital, we do have the ability to match redemptions out of the fund with capital incoming in the fund. So we think this offers a very attractive redemption profile for investors. There's a number of liquidity sources which we can use to meet redemptions that do come through.
So just to clarify that last point, should there be a massive run on redemptions, what we're saying is that the base case maximum time to get your principal back as the loans roll off and mature is an 18-month period, albeit we expect the liquidity to be much more vast than that.
Correct. Moving down the slide in terms of the allocations. So in terms of how it looks from a portfolio construction point of view, as mentioned, the first mortgage has 100% exposure to only first mortgage loans. And looking at the high yield, we have a minimum 60% exposure to first mortgage loans and a maximum of 40% exposure to mezzanine loans. Now, that does vary over time, given the underlying opportunities that we can access. Typically, that ranges anywhere from 20 to 40% at any given time. Ultimately, what we're trying to do here with the high yield product is target a return with the lowest amount of risk taken possible. So our view is not necessarily to maximize that mezzanine exposure. We want to take a prudent approach, but also making sure that we meet our return targets. And then looking at the parameters to put all this in context. So from a portfolio weighted average loan to value basis, so to summarize, the value of the loan against the value of the underlying real estate security. So first mortgage, the target range is 60 to 65%. And for high yield, the target range is slightly higher given that mezzanine exposure at 70 to 75%.
I'll just jump in with one question that's come through in relation to distributions. And the query was, will you move to monthly distributions? It's something we are looking at. The intention is that will take place later this year. It's not locked away yet. We're in discussions at the moment, but it's highly likely that by Q3, Q4 of this year, it is monthly distributions.
Now, moving over the slide, I'm talking through some of the more portfolio parameters or the portfolio's construction thesis for us. So when we look at the underlying portfolio, this is what we use as a guide to make sure that we're meeting our diversification requirements, as well as to help us identify what loans the fund should invest into. So in terms of a profile and a duration, the loans in the fund are anywhere from 6 to 36 months. Typically, the average loan profile sits within probably 18 to 24 months, but it does give us the flexibility to invest across different durations. Location-wise, we're very focused on the most populous and the deepest markets in Australia. So that's why we've got an unlimited limit when it comes to 100% exposure to New South Wales and Victoria in aggregate, with an up to a maximum of 60% of the portfolio in other geographies, such as Queensland, WA, New Zealand, for example. And then to make sure that we maintain our portfolio, we don't want to have any more than 30% of the total portfolio in any other individual region other than New South Wales and Victoria. In terms of property types, we're very focused on deploying capital in line with what we're seeing in the macroeconomic environment, similar to what Bruce was touching on earlier. So based on the current macroeconomic environment, we're very focused on residential living. So we can, for example, have 100% of the portfolio in residential living. Now, that's just not looking at solely apartments or, be that high rise or mid rise. That's things such as student accommodation, things such as build to rent, that entire living sector. And as well as that, we do target other exposures on the core commercial side, being industrial and large format retail. There is potential of the exposure to office, but given the macroeconomic trends, that's not necessarily where we're looking to deploy capital. But again, kind of to reiterate, we look at every transaction on its merits. But at a macroeconomic point of view, we're more focused on the residential and industrial sectors. In terms of other commercial sectors, we do have exposures to assets such as hospitality, social infrastructure, medical and life sciences. But we do put a cap on those with no more than 40% of the fund in any other commercial sector. From an underlying borrower perspective, so to make sure that we're not lending too much to a single borrower, we've got a limit of 12.5% of the portfolio. So a maximum of the portfolio to one single borrower can only be 12.5%, which we think is reasonable. We're not at that level currently, and we don't necessarily anticipate being at that level, but it's just making sure we've got those strict underwriting and portfolio construction guidelines. One of the benefits of the Australian private credit real estate market is we have covenants very similar to those of the major banks. So every single loan we do, we have a full financial covenants package. Everything has a full legal documentation package prepared by external lawyers and reviewed by our internal lawyers. And we have a lot of non-financial covenants, including financial statements, insurance certificates, and the like, to make sure that we can appropriately quantify and qualify the risk of every single transaction we're going into, to make sure that we're implementing the appropriate downside mitigation and making sure the facility is priced appropriately. From a loan to value point of view, as I said, the target for first mortgage 60 to 65, but we do have the flexibility to go to a maximum loan to value of 75%. Where we do go to that level, that transaction has to have very strong credit metrics, be that from strength of an underlying borrower or on a residential project, for example, being over 100% pre-sold prior to inception. High yield, a very similar story, 65 to 70% with a maximum LTV on any position of 80%. So again, the only time we use those higher LTV headline numbers is when we're very confident of the underlying credit of the exposure. Now looking across, construction versus non-construction. So across both products, we are targeting a 50-50% split. As you can imagine, given the nature of construction loans, and they do take a little bit of time to draw up as the construction project goes on, that does have a little bit of volatility in terms of our allocation to construction and non-construction. So from a first mortgage point of view, we make sure we've got a cap on the exposure to a single strategy of 65%, and then for high yield, similarly, a cap of 75%. But broadly speaking, if I consider the last 12 months, on average, we have sat very comfortably at that 50-50 allocation. Now moving to the next slide, if we look at the structure of the underlying fund, so as Ben Klein touched on earlier, at the moment we have around $300 million of funds under management within the product. In terms of how this capital is deployed, so within MaxCap we have what we like to call loan pools. We have 3 of them covering non-construction, construction and junior loans. Now these loan pools have been operating since before the MaxCap Investment Trust was established, and they were originally seeded by some of our older funds. Over time, we are going to be consolidating our older fund products into the MaxCap Investment Trust as part of our kind of optimization project. But in short, whilst the MaxCap Investment Trust has $300 million under management, the total loan commitment across these 3 loans totals $1.1 billion. So, when you are talking about a number in excess of $1 billion, it does indicate how well diversified these individual pools are. Within each pool across the strategies, we've got a number of different loans at varying metrics, and it does ensure that the $300 million is split very evenly across these pools. Talking in specifics from a loan to value ratio as they stand currently, so we look at the first mortgage weighted average loan to value. Currently, that's sitting at just over 60.5%. Now, if I look back at the start of 2023, that was sitting at 65%. So we have, given some of the uncertainty in the wider market, we have actively brought that down. Fortunately, we've been able to do that without materially impacting returns of that product. Now, looking at high yield, whilst the loan to value does look slightly lower here at 60.8%, only marginally higher than the first mortgage product, that reflects a point in time where we were reallocating funds away from mezzanine exposures purely from an opportunities available point of view. We have deployed capital since this point in time into junior exposures. And the loan to value of this product, broadly speaking, at the moment is sitting around 64%. So I don't want to say that the loan to value is sitting at circa 61% now. It is about 64%. But at the end of the day, we're trying to target a loan to value on that product of around 65 to 70%.
So that's still highly conservative.
Correct.
Given the introduction of the mezzanine into the mix.
Correct. And I think that kind of reiterates what I mean in terms of mezzanine. We're not looking at speculative mezzanine products here. We're looking at mezzanine exposures where they have very similar metrics to senior. It's just by virtue of where they sit in the capital stack is why they're called mezzanine. Now, if we turn over the page, some of the more kind of key points that investors will be interested in is the actual returns. So I focus on the left-hand side, the first mortgage product. So since inception in early 2023, the first mortgage as of January 2024 has had a since inception return of 12.69% net to investor. That is after management fee and performance fees. And if I look on the high yield side, the January 2024 since inception return for high yield is 11.79%. Now, I will point out, and I think investors, as you're looking at this, you probably realize the high yield is performing slightly under the first mortgage. Now, the reason for that is historical. When we first established the high yield product, unfortunately, there were a few opportunities which fell away at the very last minute, which caused the high yield fund to carry a little bit more cash than we'd liked and what was optimal. We are working to fix that, and we have since fixed that. So if we think between now and say the next 9 months, we do expect that return to significantly increase. But I just wanted to give a background to why that return is lower. So if we compare those target returns to the target returns, so on a first mortgage point of view, the first mortgage product is outperforming target by the best part of 3.5%. Now, obviously from our point of view, we're going to try and continue to maintain that outperformance, but we also have to factor in that we want to make sure that the returns that we're providing investors are strong on a risk-adjusted basis. So whilst we expect to continue to perform, I'm not sure that the 350 basis points will be maintained as much as I'd love to. And then on a high yield point of view, broadly speaking, we're in line with our target return, about 25 basis points off. And again, based on our deployment, based on our pipeline and where I'm seeing the returns over the next 6 months, I expect the high yield return to be in excess of the target within the next 6 months. Now, moving across to the portfolio construction, just to give a flavour in terms of what the portfolios look like from a diversification point of view. So if I start on the left-hand side, and this is the first mortgage portfolio. So based on some of the strong macroeconomic factors and structural factors that Bruce talked about earlier, we do have a strong focus on residential. So on the graph on the left-hand side, if you look at that light blue allocation there, 49% of the portfolio is residential, so almost half. And my expectation is that moving forward, this will actually grow. So This kind of reiterates our deployment in line with what we're seeing from a positive tailwind story on the macroeconomic front. We do want to deploy based on where we're seeing positive spots in the market, and residential is one of them. If I look at some of the other sectors there, we do have exposure to office, which we are reducing given some of the challenges that office market is facing. But in saying that, we are very confident with the office exposure that we do have in the portfolio. The residual elements there, industrial, retail, life sciences, hotels, etc., relatively evenly split. I continue to target industrial opportunities where the risk return makes sense. I would love to grow that 10% allocation. Given the competition in the industrial market, it is very hard to find opportunities which provide a strong risk-adjusted return. There is a lot of competition which is compressing returns. So we just are very careful in terms of how we deploy in that market to make sure we're finding that balance. In terms of geography, as I mentioned previously, we're very focused on the most populous and deepest markets, be it New South Wales and Victoria. So we're sitting just over 75% to those two states. That's something I expect to maintain over the long term, and with a slightly larger exposure to Queensland, purely because there's a number of state-specific structural factors there which are providing some very strong opportunities. So I'd expect Victoria, New South Wales and the Queensland exposures to be very similar, with the rest split across the residual states and New Zealand as well. And then finally, on the right-hand side, if we look at loan type, 90% of the book is in either pre-construction or construction itself. So the darker blue allocation there is the pre-construction, so site acquisition, buying sites from developers with development approval who are looking to move those sites into construction within the next 12 to 24 months. And then that 30% there is the actual construction phase. So helping to develop some of these assets across their construction projects eventually to selling or to refinancing at the back end to exit our facilities. Moving across to the high yield, it's a very similar story, so I won't go into as much detail, but if we go from left to right, from a sector point of view, again, even further heavily skewed towards residential, given there is a little bit more of a risk profile when it comes to mezzanine exposures, we are very focused on our mezzanine exposure being in the residential space, particularly in the apartment market where we are seeing a number of pre-sales and very strong credit metrics. Again, geography, very heavily skewed towards New South Wales and Victoria with that allocation to Queensland for reasons as I mentioned previously. And then loan type on the right-hand side, similar story in terms of about 75% of the book is exposed to pre-construction, developing the site, buying the site, with development approval in place. And then there we've got construction as well as investment. So a mezzanine exposure on an investment asset, for example, an industrial site which has a tenant paying regular lease income. That's what we mean by an investment exposure. In terms to close out, I think the reason for me is in terms of why should private capital investors invest into a fund product as opposed to investing on a transaction by transaction basis. I think firstly, a fund product makes sense from an overall portfolio point of view, and it should be a core component of any portfolio. It provides a good kind of diversification benefit, and as well as it provides kind of a strong platform that requires very little management from an investor level. Another benefit of the fund, private capital is investing alongside some of the largest onshore and offshore institutional funds. So a private investor might be coming in for 100,000, for example, alongside an institutional investor who's coming in for $100 million. The fund also benefits from MaxCap's brand and market, a very strong brand and market, and the kind of loan opportunities that this brand brings to us. Thirdly, MaxCap's underwriting platform is leading in market. Before Apollo acquired MaxCap, we had the strongest underwriting platform within market. Since Apollo's acquired us, that's only strengthened, and it's gone from strength to strength, and it's something that we continue to work on and something that we're very proud of. To give a little bit of color to that, in terms of our underwriting platform within our business, we have a number of experts across various factors, including valuation, construction risk, legal, that help to facilitate the underwriting process to make sure that we're quantifying and qualifying all of our risks and structuring these appropriately so capital and income of our investors is protected. And similarly, every single deal that goes to the fund has to be approved by MaxCap's investment committee, a committee made up of both internal MaxCap staff, including one of our co-founders, Bryce Sikorski, as well as independent members, including Apollo. So that's something that we view provides a real strength. And lastly, and most importantly, from an investor point of view, a reason to invest in the fund is it provides very strong risk-adjusted returns with a very favorable liquidity profile for our investors. So we definitely think it presents a great opportunity, and it's something that we would love for you to consider as part of your overall investment portfolio.
Thank you, Baden. Well done. Good insights. So just leaving the contacts page on the screen for you to reach out to your relevant and respective representative from MaxCap, should you wish to reach out with any queries following the session. But we will move to a few questions that have come through. So there was a question here regarding the split between institutional and private capital in the fund at present. And it sits at about 2/3 insto, 1/3 private, which is largely mirrored to our overall book, interestingly. So it's about 65-35% to date. Another query on the LTVs being based on end value for a construction loan. Look, as we've always done, MaxCap lends on an as-if complete basis for any construction loans. That is market standard. Anything that is non-constructed is on an as-is basis. So that might be site acquisition. It could be term debt, such as residual stock. Once a project has finished.
And then maybe just to comment on that, the as-if complete values that we do use for our construction lending are heavily scrutinised. So whilst we do get independent valuations for every single project that we do, including construction projects, our internal valuation teams and experts, they do heavily scrutinise those. And often it's a case of us working with the valuer to point out where potentially values might not be correct, to make sure that we are using a security valuation, which we truly believe in.
There's another question here relating to our track record in terms of capital loss of principal or interest. So to date, over the circa 700 loans we have originated, the track record remains pristine. I will note though, there is a loan in New Zealand which is due to settle in the coming 6 or 8 weeks. That will be a full principal return. It will represent the first time we haven't returned full interest. It'll be a marginal interest return. It was a very large land loan, which we're quite pleased to get out with that kind of result, given the scale of it. There are a couple of other loans in default, which are on watch for us, which we continue to work through. The ones which have exposure to this particular fund, we are highly confident of a full P&I return. There's another question here relating to how long will it take to get deployed if I enter the fund? So we expect you can enter the fund on the 1st of any given month. So for example, the upcoming entry point will be April. So that'll be April 2, given the long weekend. We have full expectation that you'll get deployed in full from day one. We'll call up 100% of your capital. You'll start earning interest on 100% of that capital from the 1st of April, even though we're calling for the funds. So you're already getting a day's free interest, winning from the get-go. Does the investment trust mean that you will be reducing deal-by-deal opportunities? No, we don't expect that we will. There are always a myriad of reasons as to why the deal flow is being syndicated privately. As Baden spoke about, the concentrations, it might be borrower concentration, geography. It could also be capital at the time. As you would be aware, if you participated in private deals, they do move very quickly. Sometimes the fund just can't move at that pace, given these guys run a really tight ship with their deployment and their cash flows. And there might be opportunities as well where we split it. And that's something we do like to do quite often, where the fund may look to take half and we go to our private syndicates for the other half. Look, I think that wraps up most of them. If we have missed any, we'll be sure to address them after the fact. Please reach out should you have interest in any of the opportunities that we've presented today or spoken of. You can see the contacts there on the screen. If there are any subsequent queries, if you'd like to see the investor deck for the fund or the IM, please let us know. We do require some time to onboard investors. Typically, that's about 5 to 6 business days before the end of the month, if you do wish to enter in the following month. So I'll wrap it up there. Thank you for your time today. Thank you for taking the time to dial in and for your ongoing support of MaxCap throughout. Have an enjoyable day, and I look forward to catching up next time. Thanks, Bruce. Thanks, Baden.
Thank you.